Hey, it's Adam Tracy. And a couple weeks ago, I did a video on token buybacks, which emulate equity buybacks in the real world. Where if I have like a share of Tesla, there's a share buyback. I hold on to my shares. I now own a greater pro rata interest in Tesla. And the point that I made in the token buyback argument was that if you have a utility token, which conceivably, right? Like the purpose of an equity buyback is like for the price to appreciate, okay, on the open market. In a token buyback, which presumably, like it's trading on a centralized exchange or otherwise, it's not a security, which means that token doesn't reflect some pro rata interest in any sort of platform or entity or anything like that, because it's by nature just a function. It's a license to do something. It's not a right to receive distributions or anything like that. So the reasoning and the rationale behind it, when you compare it to, the financial sector, kind of falls apart, right? Like, yes, it increases scarcity, right? In the sense that now there's less tokens, and for utility token, like that matters, right? From the sense that in trading now there's less of it and people want it, well then the price will go up. But the concept of dilution doesn't really exist when you don't own anything, right? When that token doesn't represent ownership. And then the question that I got in a follow-up from a few people was, well, just because you buy the tokens back doesn't mean the tokens get leaked out again. And that's true. So the second end of it, right? And, buying the tokens back is one thing, and it's a function of treasury management, which I'll get to in a minute. But the burn function is perhaps the more important element of this, right? And, for those of you who aren't aware, it's a token burn is just basically buying back tokens or allocating certain tokens that were in treasury and then sending it to an address that's a one-way ticket to nowhere, right? Those tokens can never go back out of that address, and it's very transparent. You can see it and all that good stuff. But, so you look at it and you say, okay, well, what's the positive benefit of it versus a buyback or really any of it? And one, you go back to the scarcity, right? You reduce supply, you increase scarcity on a market level, right? So like just from a trading aspect, where if you own, if you own this utility token, your only real exit from the like perspective of how am I going to make money is for the price to appreciate and you to sell it. Okay, so that's point one. Point two is to stabilize an ecosystem. So if you have like a true license type utility token where it's this access function where I own the token, I can go onto your platform and do something with it. I can play a game, I can buy something, what have you. But over here, you also have this secondary market, which whether or not you took direct action to create, like it may show up on a deck somewhere, well, you need the price of that token to remain relatively stable, right? Because if I'm paying for something, right, to do something on your platform with that token, if it's the value of it, right, on an exchange is wild up and down and not, relatively within means or something like that, well, the price of what and the value of what the token is used to do changes, right? Because now if like you buy the token at $1, well, it dips down to 50 cents, you still charge $4 to play the game, because now it charge that it's exponentially more, twice as many tokens to play it, right? So that's where this function of like treasury management kind of comes in. And like, I've mentioned this in another thing. The biggest buyer and seller of Apple Computer in any single day is Apple, right? And they call that treasury management, but what they want to see is not wild spikes in the price. They certainly do want to see wild downturns. They want to see like steady price appreciation. And that's a hard thing to do in crypto, but it can be done, right? And you can do it through buyback. You can do it through like a treasury allocation where, like, on a day-to-day basis, you're literally in the market trying to manage that price so it stays within this tight band, so the utility function of the token is preserved, right? Like, that is completely it. Then the third reason of the burn is to manage governance modules, right? And then drive engagement. Like, does a token and voting just like start that burn? Like, how do you keep people engaged? What is the hook for somebody to buy a token that's really driven, or it's like functionality, utility is really just governance, right? And again, not distributions because it's a security and it wouldn't be trading. But how do you like keep people engaged, and how do you get people to keep buying that, right? And like one of those models is to have, a token burn associated with voting and things of that nature, right? So those are the three advantages, but the pitfall is that you're just not a security. Like, there's no tying of the token to any sort of right or privilege that would be economic, other than this perceived accretion of an appreciation of the value of the token. But that's not even totally true, right? You see a buyback they announce a buyback in, the equity sector, you'll see the price pop up. It's almost guaranteed, right? If it's a liquid security. Well, here, it doesn't, in the crypto world, that's not a guarantee, right? That's not an absolute guarantee because of, radical inefficiencies in the market, illiquidity, and the basic fact that if I have no use for the utility of the token itself, which most people don't, it's pure speculation. And it's wild speculation that people will even notice that there's this perceived lack of scarcity, because if you're not actively managing it and you're not actually timing the buyback and burn to reflect, an announcement or something that would increase the desire for people to want to purchase the token, it's just not going to have the desired effect, because financially it means nothing to you. It means absolutely nothing to anybody, right? So mechanically, quite simple. In my mind, unless you are out there doing treasury management on a regular basis, right? Or you have an ecosystem where the price is just so volatile that the utility function is completely lost, there's really not a lot of use for it. Like, you can do it, and it's just window dressing, and it may work. It definitely may work, but it's a lot of window dressing that may not have the desired effect, right? And it's like the boy who cried wolf. Like, the next time you do it, no one will pay attention. So that's where you kind of have to look at it and say, all right, am I going to actively be doing this on like a daily basis, right? With what presumably would be like treasury. So that's my take, long-winded take, but very accurate, because it's not, in my mind, a one-time thing to do it right. Legally, there's some nuance to it and how you want to do it and the like and what you want to disclose, but it's not terribly difficult if you're not a security, right? So your questions, token, buyback, burn, anything you want to talk about college football, let me know. Adam, adamtracy.io. Talk to you next time. Cheers.